Moore with Global. Hi, it's Ken Moore with Global View Investment Advisors. This is basically the third week of the coronavirus bear market and recession. I'm giving an update to my clients. So let's jump right in. This week, the Federal Reserve and Congress seem to be today passing a stimulus bill to help provide liquidity and assure investors that all is not lost, that this is temporary, that this is an event, and that we're going back to normal at some point. And so the question is, at what point? Well, there are a couple different views on that, and I favor Bill Gates' view, as he shared in a recent TED Talk. Bill Gates said, if we take the hard steps, if we now quarantine, use social distancing, minimize the spread of the virus, that we can be through this in as quickly as 6 weeks, and we should know how we're faring in 2 weeks. Now, it looks pretty good outside of New York City and some other places in the United States. It looks pretty good in South Korea, and it looks good in many small places in the Far East and even China. So we have lots of learning to leverage from what they know. So what's happened so far? The markets quickly priced in a terrible economic hit from the coronavirus. And that's stocks globally, the U.S. international emerging markets. That's bonds globally, U.S. international emerging markets. This is an unprecedented opportunity. It's a once-in-a-century event. Didn't happen again, hasn't happened anything like this since 1918, when we had the 1918 flu, which was then called the Spanish flu. The federal and government response has been like a nuclear bomb, to quote many market pundits who've studied these things over the years. That's a good thing. And how fast the economy recovers depends on how we manage the pandemic. Bill Gates had a TED Talk on Tuesday, and I listened to it 3 times. In that TED Talk, Bill said, listen, guys, we're going to get a pandemic. It's going to strike, and it's going to be deadly, and it's going to be all over the world. This was 2015. No one listened. No one took any measures. The only countries that took any measures were those already affected by something tangible, like South Korea and China with the MERS or SARS that hit a few years ago. Fortunately, South Korea already had testing in place and infrastructure to rapidly administer tests. We'd love to have the South Korean experience where we get through this in 2 or 3 weeks. Unfortunately, we delayed about a month. We wasted the month of February, and we only got on this, and as did Boris Johnson, who now has a COVID-19, and Angela Merkel in Germany. So, mistakes were made. That's behind us. What's happening now? There's been a double bazooka. The Fed is buying bonds to ensure functioning markets, including corporate bonds for the first time. They didn't do that in 2008. And that's exactly where there was weakness in the bond market that spilled over into other areas of global bond markets. And that is healing right now. The other thing that it should be passed today by Congress, has been approved 56-0, I believe, in the Senate, is a stimulus bill. And it's $2 trillion. And yeah, it has some pork in it. It's got $200 million worth of pork that, is the Kennedy Center and whatever else. And I'm not going to argue whether they're good ideas or not. I'm just going to say it has nothing to do with coronavirus. And then there's some contention about the 450 million or so loans to businesses like Boeing and GE. It still remains to be seen exactly how it comes through. And my strong hope is that unlike 2008 to 2009, this time we attach warrants or some kind of participation in whatever we lend to these companies so that the U.S. taxpayer can make money on it. Not just lending for free, because the U.S. government is acting as a lender of last resort, and the U.S. taxpayers deserve compensation. Now, what's really good about it, I think, are the small business loans, $350 billion to support small businesses with under 500 employees make payroll for as long as the next 2.5 months. So this should keep a lot of these small restaurants, retailers, and other small businesses that not through no action of their own aren't working and aren't out doing what they were doing because of this humanitarian crisis. Hospitals and veterans care are getting over 100 billion. And then you've got another billion or so going directly to people who suffer this time. Far cry from what happened in 2008. This is good. There's going to be over 300 billion in household payments. This is a check to everyone who falls below a certain income level so that they're going to have some extra money for the next couple months to pay rent, pay utilities, buy food, and the other things. And then there are going to be tax deferrals and extended deadlines, which are valued at about 200 billion. And then the Fed is going to back up unemployment insurance. So every dollar the states have to pay, they're going to match that up to some limit. And then there's going to be, yes, 30 billion that's going to help out Warren Buffett and the other people who own the airlines. But it's also necessary because these companies are down, and hopefully there can be something tied to that too, and 150 in other aid to states. So this overall, I think it's a very useful and necessary bill, while not perfect. So this response is incredibly important because it restores liquidity and confidence. It ends panic selling, restores fundamental value, which was extremely dislocated like no other time I've ever seen or imagined in history, especially because it seeped into what we felt to be and still believe to be the lower risk mortgage-backed securities, which many of our bond holders, including Semper, Angel Oak, PIMCO, and nearly everybody who was thinking about this, owned these mortgage-backed securities because the consumers are in such excellent shape, unlike a lot of the companies out there. So this should seep back into it. We should see recovery in whatever short-term losses there are in those bond portfolios. In fact, Treasury Secretary Mnuchin has assembled a mortgage lending task force to make sure mortgage payments go to the companies servicing them, and that those are good bonds. That's what the Fed's doing. It's the most important thing of all. And the second thing that's important is that this money is making its hands into consumers and small businesses. And it helps everyone to see this is a temporary event. This is not a permanent, irreversible mistake. It's something that no one's at fault for, and it's something that the government is trying to reduce deaths, reduce cases, reduce the number of people who are very ill, and reduce the deaths. And so, yes, it has an economic cost. Bill Gates, and I agree, put the cost in the range of about $4 trillion. Well, guess what? The Fed bills $2 trillion, and there could easily be $2 trillion more coming. Now, yeah, sure, someone's got to pay this back later, but we can worry about that later when there is a later. So again, the bond market was pricing in the consumers with a high credit score. We're talking FICO scores of 750 to 850 or whatever the upper number is, were not going to pay off their mortgages. The bonds, many of these bonds fell to 30 cents on the dollar, $40 billion in 2 weeks. That was last week and the week before. Flowed out of corporate bonds, which is the worst month on record for investment grade credit. Again, we think this is short-lived, and for the reasons that I said, it's been shored up by the Fed, and there's a task force on mortgages. It's a well-reasoned response. We're adding to these positions where we can and appropriate, and trying to find other ways to play this game. So how long will this recession be? It really depends. It depends on how we handle this coronavirus. All right? So there's one scenario where the virus is well contained, and the most impact is right now going into the second quarter, which begins in April. If that happens, and we're out of this in 30 days, then we will have a V-shaped recovery. The economy will be back and kicking like normal. I'm assured that that is a reasonable scenario because it's the base case that has been put forth by most of the portfolio managers that I've talked to and many of the economists that we've talked to. There is, however, another case that it's harder to eradicate. It's still with us in the summer. We're working on it at Christmas time. If so, not everybody's going back to normal. We're slowly going back to normal in pockets, depending on how the virus happens. And that's going to require, I think that both of them could require, that we're doing some kind of screening for who goes where and some kind of broad-scale testing. When I say broad-scale testing, I mean a lot of people who are symptomatic get tested everywhere in the US. It doesn't mean everyone gets tested. For example, in South Korea, 99.4% of the population did not get tested. 0.6% of the population did. And that's of those countries most impacted, that's the highest test rate that there was. So we're talking about a pretty high number of tests, but it's not ridiculous. And I think we're moving towards getting it done. So just to kind of review what's happened with some of the investments, our higher risk, for example, Grander Peak, are down like you would expect during a crisis like this. For example, the Global Stalwarts Fund is down about 20% through yesterday from the peak at the end of January. Now, small caps in the US are down 28, and the All Cap World Index is down 25. So just to put this into context. Moreover, Grander Peak, with whom I've spoken to, and they wrote some very encouraging words about how to look at all this, because they're the most bullish that I've ever seen them, at least since 2011. They launched a new fund called the U.S. Stalwarts Fund, which will focus on the small mid-cap range in the U.S., and which is a great idea for anybody who's got extra money and they want to put something to work. Similarly, our stock portfolio, as well as the moat type of investments, those wide moat companies and the global one, are doing really quite as you would expect during a scenario like this. And so I keep a back test of, I don't have a consolidated portfolio for the stock portfolio, but it's down somewhere in the 16 to 20% range off the top, which is nearly it's a little better than what the market's doing in red there. I have the Russell 1000 depicted. Now, what has been more challenging for us has been the low risk bucket. So even our more conservative clients have been negatively impacted in a way that we never foresaw could possibly happen, because this hit, instead of companies, instead of ridiculous bad practices, unsuspecting consumers who didn't think there'd ever be anywhere in their imagination something like this that would require them to stay home. And then some of the powerful players got out there and pretended that this was going to be a depression and forced prices down. Now, Just to put this in context, we were avoiding corporate debt for a very simple reason. Corporate debt as a percentage of GDP had risen to almost 50% by the end of last year. Now, at the same time, you can see that consumer debt, the service of consumer debt, had fallen to somewhere in the 10% range, which is in the lowest end of the range it's been since 1980. And it was up to over 13% in 2008. So this is absolutely, we have the strongest consumers in relation to corporations, I think, in history. And the default risk of the mortgage market is at lows not seen in any time in history. So it's a very, very low risk place to invest. And we were investing through residential mortgage-backed securities in many of these funds. And there are all kinds of different ways to do it, but we were investing across the spectrum of prime, near prime, and some subprime. But even the lower risk stuff that we were doing had average FICO scores in the mid 700s. So we're talking about things that just made perfect sense to everybody. And we did due diligence on. We still feel they're great investments, but they got marked down some. So some of these got marked down so much that there was suggestive that consumers overall weren't going to repay the mortgages. Now, these residential mortgage-backed securities started being issued after the great financial crisis to make sure that we didn't have another event like the Great Depression. It's now a $330 billion market, and they're a byproduct of the lessons we learned in the housing crisis. So it's been a collaboration between every entity out there to provide these securities to people so that they could, so that the other agencies other than banks could take up where the banks left off, lending to consumers to take these loans. And when we looked at the risk of them, and this is the risk through the end of February, which gets updated at the end of each month, it's going to be quite different after the end of this month. You can see that three of the two, PIMCO income in blue here, this is a measure of risk which goes to the right is more risk and to the left is low risk, standard deviation, and in return, low to high. So we have the bond aggregate, that is the overall bond index, which is 70% treasuries. This is your risk reward for that over 3, standard deviation with return around 5 for the last 3 years. If you look at PIMCO income, we have a standard deviation close to 2, and we had a return of 5. And if you look at some of these other mortgage-backed securities, we have standard deviations less than 1, or on this metric, and we don't simply look at this, I'm showing it simply as an illustration. They were a third the risk of the overall bond market. Now, I don't think that's true. We felt some of these were a little more risky, and some of them were in line with risk. But it's certainly valid to say that they're acting right now like they've never acted in history. So the point is, some of these funds are down 20% or more. We have one down more than that. And we believe this is technical. We're speaking directly with Semper, with Angel Oak, with PIMCO, and with Braddock and other managers virtually daily. I've been on calls or in conversation with or emailing back and forth with these guys every day. And there have been very long days, and we're doing everything we could possibly do. And I want to reassure you that we believe, like these portfolio managers and like others who I've spoken with, including I have a friend who's retired mortgage-backed securities guy who worked for Liberty Life. He bought mortgage-backed securities for them. He said, this is money good, it'll be good by June. I can't promise that. We feel like it's going to be substantially back in a year, and in the meantime, we're getting better than we thought coupons. And we're seeing these managers are seeing inflows, which is a very strong indicator that things are returning to normal and that the rational folks like we feel we are taking advantage of it. So we see this as something that's temporary, going to pass, and trying to capitalize on it to take opportunity. Now, another thing that we want to do, which is quite difficult for us to do just because things move so quickly, but we hope to take advantage of, is some dislocations in the closed-end bond market. And I know this is kind of complicated here, but I'd like to show you, let's focus on this graph in the lower right-hand corner, that when you have a discount of over 8% in a closed-end fund, which is a basket of securities that trades at market price and the price of which is impacted by retail investors who buy and sell based on fear and greed, then we can see that the net asset value of the loans in the portfolio might be $1, but they could easily fall to 92 cents, these closed-end funds. And we've seen them at 20% recently of very good quality AAA municipal bonds, for example. I'm just making one example. And when that has happened in the past, over the next year, we've seen them completely come back to par. And at the same time, quite often the price of the securities raises. So you get paid a nice dividend, and you get paid something to come forward, to go up as the price comes back to par and the discount goes away. We're trying to take advantage of that. So we'll keep you update as we are. And I wanted to just tell you, it looks like things have really gotten better this week. And so there's light at the end of the tunnel. This thing could go away anyway because of seasonality. We'll see. We're going to have more cases, and we're going to have more deaths in New York and some other places like that. But if we do things right, we hope that this will be over sooner rather than later. I hope this is helpful, and we're always here to help and answer your questions. Thanks very much. We'll talk to you soon.